Have you ever wondered if a notoriously volatile fashion retail stock could actually offer both high profitability and low-risk Sharia compliance? It sounds kind of like a financial paradox, doesn't it? I mean, high fashion usually equals high risk. But today, we're looking at the hard data to see if an apparel giant can actually anchor a truly stable Sharia-compliant investment portfolio. Welcome to today's Explainer. We're putting Padini Holdings Berhad literally under the microscope for a really comprehensive financial deep dive. We're going to examine their performance to decode exactly how this company operates on the Bursa Malaysia and figure out whether it actually stands up as a solid, secure investment. Okay, let's dive into this. Here's our roadmap for evaluating this stock today. We'll start by meeting the company, check out the stock price roller coaster, and look at its core financial vitals. Then we'll weigh profitability against financial risk, examine the macro market trends, and finally deliver our investment verdict. Section 1. Meet Padini Holdings Berhad. If you've ever shopped in Malaysia, you absolutely know this name. Founded way back in 1971, Padini has grown from a simple clothing producer into an absolute giant in Malaysia's consumer products sector. Headquartered in Shah Alam, they design, produce, and distribute apparel and footwear. And by housing a bunch of diverse brands like Padini, Vinci, Seed, and PDI, they successfully hit a really wide range of consumers, specifically targeting that low to medium cost fashion market. But here's a real game changer for investors. Padini is officially approved by the Securities Commission Malaysia as a Sharia-compliant stock. What that means is its business operations strictly follow Islamic investment rules. Because they stick to these ethical and financial guidelines, the stock naturally offers a much more moderate risk profile. That makes it incredibly attractive if you're looking for stability in a retail sector that can, honestly, be pretty chaotic. Section 2. The stock price roller coaster. And this brilliantly illustrates what trading this stock actually feels like day to day. Over a 50-day trading window from April 30th to June 20th, you can immediately see the high volatility. We've got plenty of long red candles showing massive selling pressure, bouncing back and forth with green candles where the buyers step in. Over the specific window, the stock didn't really establish a clear long-term trend. It just kind of bounced around. Breaking that down, it's like watching a tug of war. Early on, strong buyer demand pushed the price right up to bullish highs between 1 ringgit 49 cents and 1 ringgit 52 cents. But as it moved higher, people took their profits. That caused a bearish downturn, hitting lows of 1 ringgit 38 to 40 cents. After that bull momentum finally cooled off, the price consolidated and basically just traded sideways in a really tight range between 1 ringgit 42 and 47 cents. It's a textbook story of market indecision. Section 3. Checking the financial vitals. First up is return on equity, or ROE, and it's sitting at a very healthy 13.48%. This metric tells us exactly how well management is using shareholders' money. So in plain English, Padini generates roughly 13 cents of pure profit for every single ringgit of shareholder equity. That is highly effective resource management, proving that consumer demand is directly translating into constant profit. Next, let's look at the price to earnings, or PE ratio, sitting at 11.42 times. This calculates how much investors are actually willing to spend for each ringgit the company makes. At 11.42, the market basically considers this stock fairly priced. It's not running on overvalued hype, it shows true earnings stability, and tells us investors have reasonable, grounded expectations for future growth. Now, what's really interesting about this slide is the dividend yield. At 5.36%, Padini is giving investors a really stable, consistent return on their money just through dividend payouts alone. In a volatile market, a reliable dividend strategy like this is a huge deal. It proves the company has the cash flow to consistently reward its shareholders. Section 4. Profitability versus financial risk. So profitability is undeniably high. But we do have to look at the other side of the coin, the liabilities. Padini's total liabilities grew from 2024 to 2025. That means their financial gearing, the debt-to-equity ratio, actually ticked up a bit year over year, from 0.64 to 0.73. So recently, a little more financing is coming from borrowing rather than share capital. That does indicate a slight bump in financial risk. But let's put that risk into perspective, okay? Because that debt-to-equity ratio is still well below 1. Padini is predominantly equity financed. They are not over-leveraged at all. So yeah, the debt ticked up slightly, but the overall financial risk is actually quite moderate and super manageable. They are still in a very stable financial position. Section 5. Macroeconomics and market trends.
Let's zoom out a bit. The most immediate macro threat out there is the chain reaction of inflation. You know how it goes, general prices rise, so our purchasing power drops. Because Padini is in fashion, they rely heavily on consumers having extra cash to spend. When inflation is high, people hesitate to buy non-essentials like new clothes, and that threatens retail revenue. However, and this is key, Padini wears a very specific type of armor here. They intentionally cater to a massive, budget-conscious customer base with low prices. That strategy heavily mitigates the inflation risk.
Right alongside inflation, we've got to watch interest rates. This is like a giant macroeconomic pendulum. When interest rates rise, disposable income falls and consumer spending just drops. But on the flip side, declining interest rates encourage people to borrow and spend more, which acts as a huge tailwind for Padini's revenue. Ultimately, they are constantly navigating this shifting macro landscape.
Section 6, the final investment verdict.
So the crucial point is this. Padini Holdings Berhad stands out as a relatively stable, low-risk investment option. Honestly, despite those macroeconomic headwinds and a slight uptick in debt, they've got a lot going for them. Their highly efficient ROE, a fair PE valuation, a strong dividend yield, and that Sharia-compliant status totally outshine the moderate debt risks. Their dominant market position just makes them incredibly resilient.
But of course, the market never sleeps, right? As global inflation and interest rates inevitably shift over the next few years, how long can Padini actually maintain this low-risk stability? Will their budget-friendly strategy be enough to weather the next economic storm? It's a fascinating question, and one that should absolutely leave any savvy investor eager to track this stock's next move. Thanks so much for joining me for this explainer, and keep your eyes on the data.